Everything has a price. But the most important prices in life don't appear on labels. They are hidden in the shadows. I'm waiting for the bill to come due when you can least afford to pay it. You have three options: pay $30,000 for it, find a cheaper used alternative, or steal it. 99% of people avoid the third option, knowing the consequences of theft far outweigh a temporary free ride. Yet, in investing, millions try to shoplift their wealth every single day. They want an 11% annual return over 30 years to secure their retirement, but they try to avoid the price by trading in and out, attempting to sell before recessions and buy back before booms. They want the reward without paying the price. Successful investing demands a price. Its currency is not dollars, but volatility, fear, doubt, uncertainty, and certainty, and regret. These are easy to ignore on a spreadsheet, but agonizingly real when staring at your screen in the dead of night. Why do we try so hard to avoid this per price? A speeding ticket is a fine. It means you did something wrong and are being punished. The natural response is to avoid it. But a Disneyland ticket is a fee. 18 million people willingly pay it annually. No one walks through the gates feeling punished. Market volatility is not a fine. It is a fee. It is the price of admission for long-term compounding. Today, we dissect the final chapters of Morgan Housel's The Psychology of Money. We explore the ultimate cost of wealth, the mechanics of financial bubbles, and why the ultimate dividend of money is not luxury, it is control over your time. In the late 1990s, the dot-com bubble wiped out $6.2 trillion of household wealth. A few years later, the housing bubble collapsed, vaporizing another $8 trillion. The common historical autopsy is simple: greed. But this lazy explanation misses the most critical lesson of financial disasters. Every participant made decisions that felt rational to them in the heat of the moment. Bubbles occur because long-term investors take cues from short-term traders playing an entirely different game. How much should you pay for Google stock today? It depends on who you are. For a 30-year investor, the smart price is based on discounted cash flows over 3 decades. At that point, buying an overvalued stock makes perfect sense because your horizon is practically zero. Bubbles form when short-term momentum shifts the market's dominant price setters. Yahoo at a zillion times revenue wasn't irrational to day traders. They were going to sell it before the close. Or Cisco rising 300% and think, maybe they know something I don't. You buy Cisco stock at $60, valuing it at $600 billion. For you, it was a financial death warrant. This blind collision happens in everyday spending too. We see neighbors buying massive 4,000 square foot homes and leasing brand new sports cars. But we don't see that they might be investment bankers making $900,000. Or worse, they are living on the edge of insolvency, buried under $45,000 of debt. You are a passive investor playing for quiet, long-term security. Yet, you copy the consumption patterns of people playing for short-term status. Identify the game you are playing and shut out the noise. In December 2008, the Wall Street Journal ran a front-page article featuring Igor Panarin, a Russian professor who predicted the United States would disintegrate into 6 pieces. Alaska would revert to Russia, California would join China's republic, and Texas would fall under Mexican influence. This was on the front page of the world's most prestigious financial newspaper. Why is pessimism so incredibly seductive? Yet, pessimism holds an intellectual grip on our minds. Pessimism sounds smart. It sounds like someone trying to help you. Tell someone a stock will rise tenfold, and they write you off as a salesman. Tell them a stock is an accounting fraud destined to collapse, and they clear their calendar to listen. There is an evolutionary reason. Organisms that treat threats as urgent survive. In modern finance, this evolutionary shield becomes a wealth-destroying sword. In 1889, the Detroit Free Press published an article declaring human flight mathematically impossible. When they successfully flew in 1900, the world didn't notice. For 4.5 years, the public didn't believe it was real, assuming it was telepathy. Only in May 1908 did experienced reporters observe them. And when they did, they immediately focused on the negative, reporting the first aviation death later that year. The slow compounding of progress is hard to see. Growth is driven by compounding, which takes time. Setbacks are driven by single points of failure, which happen in a heartbeat. A medical miracle saving millions of lives over 50 years occurs too slowly to make the news. Pessimists look at ugly facts of today and project them in a straight line. They forget that supply and demand react, markets adapt, and human ingenuity solves problems when stakes get high. In 2008, environmentalists warned that China's growing demand would cause the world to run out of oil. High prices sparked fracking and horizontal drilling. By 2019, world oil production hit record highs, proving supply and demand adapt when stakes get high. Pessimism reduces expectations, narrowing the gap between possible outcomes and outcomes you feel great about. Imagine an alien dispatched to Earth to monitor our economy. He hovers over Times Square on New Year's Eve in 2007. He sees happy crowds, towering billboards, and bustling offices. The physical infrastructure is identical. Computers are faster, smartphones are better, and factories are completely intact. U.S. households are $16 trillion poorer. 10 million Americans are unemployed. The stock market has lost half its value. Did a meteor hit? Did a plague wipe out your knowledge? No. The only thing that changed was the story we told ourselves. In 2009, we stopped believing that story. That narrative shift alone was enough to bring the richest nation in human history to its knees. Stories are the most powerful force in the economy. They are the fuel that lets the tangible parts of the world function, or the brake that grinds everything to a halt. At the individual level, this story-driven reality creates what we call appealing fictions. Under those conditions, the human brain will believe absolutely anything. In war-torn Yemen, when a child falls desperately ill and a family has zero money, he reported perfectly smooth, positive returns year after year. It made no logical sense. But people wanted to believe the story so badly that they shut down their critical thinking and handed over their life savings. The lesson is vital. The more you want something to be true, the more likely you are to believe a story that wildly overestimates the odds of it being true. So, where does this leave us? How do we apply these psychological laws to our own lives? Morgan Housel closes his masterpiece with a rare look into his own personal finances, his confessions. His strategy is a direct challenge to academic finance. But over the years, he realized a fundamental truth. There is very little correlation between an investment effort and investment results. Today, every single stock he owns is wrapped in a low-cost Vanguard index fund. He has zero desire to beat the market, because dollar-cost averaging into an index has the highest odds of long-term success. But it is his lifestyle choices that baffle the analysts. Housel and his wife bought their home completely outright, with no mortgage. During an era of historically low interest rates, any rational advisor would recommend a cheap mortgage. But Housel's goal was never to be coldly rational. The independent feeling of owning his home outright far exceeded any theoretical financial gain. And that is the ultimate metric. Housel also keeps roughly 20% of his assets in raw cash outside the value of his house. Spreadsheets call this close to indefensible. But he does it because cash is the oxygen of independence. By maintaining a massive buffer, he ensures he will never interrupt compounding unnecessarily. He got the goalpost of his desires to stop moving. He and his wife kept their college-era lifestyle largely the same. They did not use rising wealth to buy bigger toys, but to buy back their time. Ronald Reed, the quiet Vermont janitor, who died with over $8 million because of patience. Bill, who hit the 1 in a million luck of Lakeside School, while Evans was taken by the 1 in a million risk of a mountain peak. And Gupta, who had $100 million, but risked his freedom to chase $1 billion. They were divided by their behavioral skills. The ultimate goal of money is not to impress strangers driving past in a sports car. It is to gain control over your time. That is the highest dividend money pays. That is the mastery of the psychology of money. Are you willing to pay the fee? Or are you still trying to avoid the fine? If you want to master the dark, behavioral mechanics of finance, and join an elite community of analytical thinkers, hit the subscribe button, turn on notifications, and share this video. This is Leverage Chronicles. Keep compounding.